of June, end of the first half of 2023. So I'm delighted today to be joined by Amina Bakr, Deputy Bureau Chief of Energy Intelligence, Maliha Bengali, founder of MB Commodity Corner, and Ram Narayanan, Director and Vice President of Strategic Market and Business Development at Vedanta. Thank you so much, everyone, for joining us today to have a review of the week that's just passed, and to get your outlook on the second half of the year. Really, today is my purpose. Maliha, let me start with you. We've seen a little bit of a turnaround, haven't we, in this whole sort of bullish sentiment on markets this week, including commodities and oil. Give us your take on why you think this is happening now.
Okay, so that's really interesting. The market is all about sector rotation. As we have seen this massive debate of growth versus value, which is technology versus anything commodity related, especially energy, the big macro funds are deciding what to do. Everybody wants to short technology, specifically the large 7 or 8 names, and go long value. Now, it's interesting because when they talk about value, they talk about energy and oil being really cheap at $70 or $73 per barrel. And we've seen this massive sort of shift. But what people tend to forget is that the demand is just not there right now. Prices may be cheap, but we know they're holding up here primarily because OPEC has been cutting production. But in terms of the global recession backdrop, there is no indicator to start buying either copper or coal or iron ore or anything China related, because the demand has been very weak across the board. If you look at the data yesterday that came out, inventories are still building on the product side. Margins are okay. SPR is drawing. So the oil market is really holding itself here, but there's no demand upside. And what we remember is a lot of the analysts are talking about second half demand pickup to see a massive deficit. We see no signs of that. And all the hopes are predicated on China coming back and boosting their demand through economic stimulus. But then again, once again, that's disappointing. So there is all hope and not actual numbers. And that's just sort of this whipsaw action we're seeing between technology and energy that's driving oil price and oil price stocks right now.
Okay, thanks, Maliha. Ram, let me go to you on that sort of demand outlook front, both for India and China, more importantly. We have seen demand in China in this first half of the year. There has been growth. A lot of people say we just put our expectations way too heavily on that reliance. But what is the outlook, do you think, for the second half? Are you one of those who thinks it's going to be a story of two halves this year, with more pull of demand from China to come?
Yep. Thanks, Dal. I think I can't agree more with what Mali has said. I think there's more of a sentiment over demand. And that's what happened the month of January when China opened up and everybody thought China will pull up the commodities market, but it doesn't happen the first half. And if you look at the indicators that's coming up right now, the housing market has not picked up. The infrastructure market has not picked up. And then the stimulus, which has come up in the last 2 to 3 weeks, I mean, the market's not reacted very positively to it. So therefore, to answer your question, whether what is the outlook for the next half, I am not very, very optimistic that the next half is going to be any better than the first half. The reason being the demand is simply not there. That's point number one. And we've seen some optimism because of this stimulus, especially seen iron ore prices went up a bit, coking coal price went up a bit. But it's not something which you call as a structured increase in demand. It's more of sentiment that's coming into play. So to answer your question, I don't see any major pull in commodities demand in the second half. Coming to India, we had it's been doing pretty well, but in the last 2 or 3 weeks of June, we've seen a slight softness in demand. Monsoons are about to set in. And we have seen with the steel prices going down, we've seen some drop a little bit in steel prices also. And with the commodities prices coming off, a little bit of slowness in demand in aluminum and other base metal prices. But all demand continues to be strong. So therefore, India, even though there's a little bit of softness we see out here, but we see a good firm demand coming up in the next half also. So that's what I see from the Indian market. Monsoons might be a little bit slow, but still then after monsoons, markets will pick up. So that's the outlook for India.
Okay, thanks, Ram. I'll come back to you. We'll talk about that Indian crude demand as well, in particular, and their imports from Russia.
Sure.
Amina, welcome and good morning again. The headlines I've been getting this week from people we've been talking to, let's talk about supply now and put demand aside, is that yes, we definitely need a demand miracle to come to the rescue of oil, because we have plenty of supply, despite the OPEC cuts and the most recent voluntary announcement by Saudi. And yet oil prices have kept falling this week. So when are we next going to see, Saudi intervene again, do you think?
Good morning, Diala. Good morning, everyone. And good question on the supply side. Diala, I think I mean, for the time being, we can't, I mean, sure, when OPEC Plus did announce their cuts, we didn't see a spike in oil prices. If you would have gotten this announcement previously, Saudi Arabia doing a unilateral cut of 1 million barrels a day, we would see a huge spike in prices, but we haven't seen this. And this is because of this detachment between sentiment and fundamentals. There's still a belief in the group that demand is going to pick up by the second half of the year, and these cuts are going to have a delayed impact on the market. Sure, demand isn't picking up as much as fast as we expected, but we're not seeing major revisions by any of the big analysis houses out there, including OPEC, the IEA, etc. We might be a little bit more conservative at Energy Intelligence, but we haven't also revised our demand numbers down significantly. When we would see more action from OPEC Plus, I mean, they're just waiting to July didn't start yet. So I mean, there's a point where they have to wait for the reaction of the market following the prices, and perhaps they will take more action following that if they really see no response on the demand side. But from the national oil companies here in the Gulf, I can tell you that they are not seeing signs of demand destruction. They are not seeing their base customers, especially in Asia, ask for less oil. It's not happening.
Okay, all right. Thanks, Amina, for that. We'll go back and talk about that Asian demand as well. Maliha, just back to you. You touched on obviously the markets and commodities. Just specifically talk about central bank policy. We saw a big move by the Bank of England yesterday. Some people are saying a bit higher than was expected for this particular month, and some people are saying another 75 points by September. What's going on in the UK? Is it kind of panicking in some sense, or is it just trying to support its currency? But what is the trend, do you think, for central banks going forward now for the next quarter? This talk of soft landing is losing a bit of steam.
You're absolutely right. There's an old adage, right? Don't fight the Fed, don't fight the central banks. The market continues to fight them as they think they're going to pivot. And we've seen the US regional banks go against the Fed only to lose out and actually go bankrupt. Now, the Fed actually did a pause in June. It was a hawkish pause, but they are very much adamant on getting inflation down. Now, we know the way the Fed works, and I've said this time and again, they look in the back mirror, right? They're very backward looking. So their data is a bit lagged on a 3 or 6 month basis. By the time they get the actual inflation 2% number, things are a lot worse than the economy is, but they don't have the tools to forecast and preempt. And that's what fiscal policy should be, or monetary policy should be. So in my theory, look at the RBA or the Bank of Canada, they pause and then they raise rates because services inflation is just not coming down. We know goods price inflation has come down, but they cannot afford to pause right now, because if they get it wrong, like the 1970s, their job's on the line, right? So they're going to go a bit too far. And that's been our premise all along. They're going to over tighten because until they see the data, they can't stop. And the Bank of England has done the same thing. So the ECB, the Bank of England, sort of mirrors US Fed policy. And if for right now, July is pretty much a live meeting. And if they raise by 25 basis points, potentially 80% chance of a September hike by 25. They've said 2 more rate rises. And don't forget, the market is priced in 3 rate cuts. So there's a massive sort of, a paradox in terms of what the market's doing. So my view is that the Fed is going to raise, things are a lot tighter. And when I plot all my 25 quantitative indicators, I cannot tell you how weak the economy is. Right now, we're in a massive recession. No matter what anyone tells you, we are already in recession. So if you look at the economic things and forget the market sort of 7 stocks, I think the Fed's going to go too far. And I think until they see the data down, it may be a bit too late, but they're going to keep going right now until the markets collapse. If a credit event happens, then they might stop. But nothing is happening. The labor market's strong, so they have no reason to stop.
But it is slowing down a little bit. But a lot of people are saying it will not go beyond 6-7% long term because they just simply can't afford to. But let's see what happens. Ram, back to you. You mentioned India in your comments earlier, and it's looking pretty healthy. Of course, those Russian crude volumes keep rising into India. Now it's 40% of its crude, maybe volume total-wise. It's not as significant as China. But that is quite a bit of, quite an increase for this year. Do you expect us to stay at that level, or will India continue to add more from Russia, less from everyone else?
Well, of course, you're right. Right now, crude imports from Russia come to 40%. But we also have to keep in consideration it's come at the expense of supplies from Middle East. And India can, on a geopolitical basis, India continues to have good relations with all the Middle East suppliers, especially Saudi, Iraq, and all these other countries. And then we also have to look into the fact that some of these refineries might not be able to handle the Russian crude also. So from 40%, maybe we can see some amount of uptick, maybe close to 50%. But at one particular stage, a mixture of geopolitical considerations and also logistic considerations will start coming into play. And there's another issue that's happening, like, Russians are sitting on huge amounts of Indian currency because of the bilateral trade, and without any outlook as to what exactly they have to do with this kind of currency. The one point is they can increase imports from India, but that's one thing which they have to look into. But that can be another limiting considerations for the crude trade with India. So if you ask me to summarize, maybe it will go up a little bit more, but I think it is reaching the end of the limit to which India can start India can continue to import Russian crude. But at these levels, I think it's going to remain constant at least for maybe the next 2 or 3 years till the geopolitical considerations change again.
Yeah, okay. Well, those geopolitical considerations might change again, but Amina, a lot of people are saying even once and if this war ends with Russia, that change in crude flows of Russian crude from Europe to Asia is not going to reverse. And surely that must have a medium-term impact on OPEC security into China of supply. Do you think there's any concerns creeping in there at all?
I think initially there were some concerns from the Gulf states, but at the same time, Diala, they have long-term contracts. As Ram mentioned, there's a geopolitical factor to consider as well. You have producers here in the Gulf that are reliable producers, long-term producers. So countries like India and China don't want to cut that tie, and they will sustain those long-term contracts. Yes, sure, we won't see an immediate flip in the direction of where Russian barrels are ending up. But for many refineries in Asia, they still need those heavier, sour barrels that are coming from the Middle East. That's base load for them. Anything on top, of course, I mean, who doesn't like a good bargain? And the Russians have been offering discounts. My concern really is this two-tier market that's happening, where you have a difference in pricing, and that's another distortion to the market, and it's making market management more complicated.
Okay, well, let's stick with you, I mean, and talk about two-tier, but a different aspect, which is OPEC quotas within the OPEC Plus group. At the meeting, the last meeting, we did have an announcement that they were considering the new quotas for next year, etc., and adjustments to those. And of course, the other reality is that if OPEC was going to cut again in the next few months, most of those countries just can't do that, right? So we're looking at a real split, aren't we? Which Saudi is quite happy to do, isn't it? I mean, it's saying it doesn't want to be a swing producer, but it is admitting that it's the only one that can act in the next few months if more cuts are needed.
Well, at this particular meeting, I mean, I can tell you that from a lot of the producers, there was little appetite for them to implement further cuts. Saudi Arabia added that 1 million barrel a day, and it just limited it to 1 month, saying that, yes, perhaps we could increase that if required, but it wanted to kind of fast forward the process. It called it kind of the cherry on top of the deal. But in terms of further cuts, yes, you're right. I mean, in terms of reliability on who can deliver on cuts, it's the Gulf states and primarily Saudi Arabia. How far they want to continue bearing the burden by themselves will also depends on compliance rates from the rest of the group. They're not just going to be cutting alone while they have compliance rates from others slipping. And I'm glad you brought up the baseline issue. A lot of the African states, you saw that they're going to be facing revisions from 2024, but that again is subject to independent parties going into Africa and assessing capacities. So we might see a change in those numbers. And we're still seeing many of these African states anyway struggle to meet their initial quotas. So there's no kind of, oversupply happening from those states.
Okay, and I guess that, Saudi and others perhaps in OPEC will continue to defend $70 no matter what. Assuming the world can still afford $70 oil, again, let's see what can happen. Maliha, give us a picture of how gasoline demand is doing in the US. It's driving season now. How's the pickup there? We haven't really seen a major impact on prices.
Gasoline demand's holding quite strong. I mean, it's still this 9.1, 9.3 million barrels per day. It's not picking up terribly, but it's not falling as well. But if you take a look at the oil demand picture, seasonally, that's a very strong time. But if you look at distillate demand, jet, kerosene, naphtha, all the other demand, the total oil demand is a bit disappointing. So yes, we're in a strong gasoline market, but it's not terribly high. We're not north of 10 million barrels per day or anything, but it's not enough to take the margins higher or the oil price higher overall. I think manufacturing, industrial demand slowdown is very important for the overall economy, and that's offsetting any of the pickup in travel demand or gasoline demand for that matter.
Okay, interesting. Ram, let's talk a bit about Modi's visit to the US. That's a big visit, strengthening its ties with America that are already pretty strong, playing the neutral game still, also, and how do you read what's the outcome of what we should expect from this trip? What in particular do you think they're going to be focusing on? The talk of IT deals being done, security. They want to lessen their security reliance in terms of military hardware on Russia. India does. So give us your take on what you should expect from this.
Well, the Indian Prime Minister made a statement 2 days back. India is actually not neutral. So that's
news to us. Let's see the evidence, and then we'll believe him. Yeah.
But I think it was a different context altogether. This on the lighter side. But yes, I must appreciate the present government, the way they balance the considerations with Russia as well as the Western world, and they managed to put themselves in the sweet spot. So therefore, I think that's something the present government has played pretty well. But the present visit by Prime Minister Modi has had a lot of optics, and yesterday evening or today morning rather, his address to the US State of Congress had a lot of optics, a lot of eyeballs, and it's been received pretty well. From a business point of view, one important news that just came across in my flash across to me was a lot of tariff issues between India and the USA, especially in products like aluminum, has been removed, has been sort of put off by both the countries. So obviously, from the trade point of view, it's been an excellent visit. There are a lot of deals that's going to be struck or has already been done, especially in the field of drones, in the field of technology, that's being done or almost verge of being done. So therefore, the cooperation between India and USA, especially from the security aspect, given US issues with China, has been very much on the table. That's happened pretty well. And the third point is in terms of geopolitical considerations, how India actually plays as a close ally of USA in this security context. So that's another aspect that has come up pretty well. So net, Prime Minister Modi's visit has been extremely positive, and I think it's built up on the positive vibration that's been built up between India and US for the last 20-25 years. So I think on the whole, it's been a great visit, a lot of optics, a lot of eyeballs, and hopefully it's good for the business between India and USA together too. So good visit altogether.
Okay, thanks, Ram. Amina, just back to you. We have a headline on our news bulletin today talking about Iran's oil industry, booming industry is the word that's used, adds urgency to their negotiations on the nuclear issue. But what I'm hearing, I think even what you said last time you were on the show, is that because of many factors, US elections, we're not going to really see any advance on these talks, although there's been a lot of rumors and evidence that this is getting a new impetus. But do you see any change in that in the last month or so?
Yeah, sure. There have been headlines, but it's not strange for us to see headlines. I mean, we've been through these cycles before where you had Iranian and US officials sit down and bring up the topic again. But for the time being, we're not seeing anything imminent or tangible in the foreseeable future. And I had somebody recently ask me, we've seen a surge in Iranian exports and production in recent months, and they've been also selling a lot of oil from their storage. So there was a question around if Iran is willing to accept an OPEC quota. And the answer is absolutely not for the time being, since they are still under sanctions, and they will argue that they are under sanctions. And if and when the sanctions are lifted, then they would say that they would need to ramp up their investments in the upstream sector and ensure that they have sustainable production and sustainable exports, and then they would accept a quota. So even though we see an uptick in their exports, we're nowhere near Iran accepting an OPEC quota.
Okay, Maliha, what about OPEC accepting Russia not abiding by its quota, OPEC plus? I mean, I usually put that question to Amina, but let me put it to you in terms of also evidence in the market of more Russian oil flowing very nicely. shall we just assume that Russia will not be held accountable to any of its quota cuts until the war is over, at least?
That is an excellent question and a point of massive contention in the market. And Amina and I have discussed this as well. I think for right now, OPEC and Saudi Arabia is very accommodating to let Russia do what they're, because the alliance is very important to them, to the overall group, given the experience of the last few years. But yes, I think Russia's incentive is to keep producing as much because they have to fund the war in whatever way possible. This is actually working contrary to what the top producers are feeling. Now, having said that, will they go to the point where they're like, hang on, we're not going to be paying for this cut, we're not going to be the only ones suffering for this? It remains to be seen. I have my own personal views, but it's very, very hard to say. I'm sure they're not happy because at some point, Russia will have to compensate as well. From a demand supply point of view, we've said it for the last year, like there is no shortage of supply. We just had a massive confluence of 4 or 5 bullish factors last year: the war, OPEC holding back 10 million barrels, but in a very soft COVID stimulus. So the oil market, people forget, it was trading between 45 and 65 before COVID, before anything happened. We only trading this highest of $70 plus range after the war. So the question is, what is the fair value of oil? And what would it be if we allowed Venezuelan oil, Iranian oil, and even OPEC not to cut that much? So that's the question that nobody is really willing to address. Most of the people have just penciled in $70 to $100 for the next few years, assuming that that never changes. But I think that's the bigger debate as to when that sort of flow comes in and what the real demand of oil is. And I think that's really, really interesting.
Okay, let's look at our question for today. What will have the biggest impact on the direction of oil prices in the third quarter? And there are your 3 choices: more rate hikes, which are supposedly diminishing demand, Saudi oil cuts, or China economic stimulus. So which of those 3 will have a bigger impact than the others? We've seen Saudi oil cuts have supported prices where they are, but they certainly haven't given them a boost. Many people argue that they could certainly have come down a lot more than that if they hadn't intervened. And do you think so, Amina, in that sense, that on that subject of Russia, and I know we've discussed it before, but at what point, what price do you think Saudi would finally sort of put up its hands and say, Russia, you've got to do your bit?
First of all, I want to say that there have been improvements in the Russian cuts, and I understand that, communications with regards to compliance is something that is done across the board. And there has been more pressure on Russia to stick to their voluntary cuts of 500,000 barrels per day. Even by their official numbers, they don't confess that they have done this 500,000. It's closer to 400,000, but we see an improvement. There's an effort there. And that's something that Saudi Arabia and the other OPEC Plus members want to see. And we're at a point where Russia is still being excluded from a lot of organizations. So it's important for them to be part of OPEC Plus, and they do see the value in that. For Saudi, I've said this many times before. Sure, there is a certain price and a break-even point that supports their budget, and they wish that prices would be at a certain level, but they are not in the policy of targeting prices because that's a failed policy. If you chase a price, you will not get that price. It's more about balancing control here and making sure that their voice is heard over all the other factors that we talked about with regards to the Fed, to SPR releases, etc. So they want to remain as a strong force in this market, and it's more about control and stabilizing this price. And we have to admit that they managed to the volatility level has decreased. Prices are in that 70s range. So they did achieve what they want. And let's just see after July, the impact of that million cut from Saudi.
Okay, and Amelia, we had a few questions put to our audience this week around the price band, if you like, the range that they expect the prices to be in the next few months. And most people agree now it's going to be between that 70 and 80, not going to go higher because China will stop buying it any higher and that will suppress. Saudi will support that $70 floor. Would you agree, if you had to put some money on the table, would you agree that it wouldn't sort of go beyond that $10 band?
I think OPEC has done a great job in suppressing volatility, but in our view, we think prices can break that range. Now, if you'd go back to just a few years ago when we had a recession 2018 or 2008, I don't think the market fully appreciates the extent of the recession. If we get a massive demand collapse or a credit event and actual liquidity freeze in the market, forget the US regional banks, oil prices can fall $10 really, really fast. Obviously, the key thing is if Saudi comes in and cuts 5 million barrels per day or 10 million barrels per day, it can support that price level, but price will only just spike up and it'll fall right back down. So it's a very precarious scenario. I think we think it can break that range. If nothing changes and we manage a soft landing, which I'm sorry, if you go back historically, we've had the most aggressive rate rising campaign. You think that we can actually have a soft landing. I think one is to be deluded to think that, yes, if China comes back, we can go back to 100. But right now, the demand supply is very much in the favor of downside. The key thing is how much is OPEC or Saudi willing to cut to give that stability that they want? And I think that is a very, very delicate task because we believe in free market economics, let the prices sort of fall and eventually demand will return. The more you delay the inevitable, demand will take longer to come back, and that's much more precarious.
Yeah, I mean, in the end, it's going to depend on that demand coming back, isn't it? Really, to keep prices here comfortably. There's a limit to how much Saudi will continue to cut. Maliha, just sticking with you, how much money is there left floating around? This liquidity that we're talking about, that's supposedly being now sucked up by the hawkish policy, but there still seems to be a lot of money looking to place itself, right? I mean, when will that finally dry up?
So the Fed balance sheet is revealed every Friday morning. So the Fed's actually really, really smart. On the one hand, they talk about quantitative tightening, which they are doing. We've seen the numbers go down. But on the other hand, they're actually pumping money to the BTFP programs and the banks to support the system. But net, you have to look at the reverse repo, the TGA. And I think liquidity has been coming down, but from April to May, it was going back up. Hence, the markets were very strong. But recently, in the last 7 or 8 days, net liquidity across 4 or 5 different metrics is coming down. Global M2 money supply is coming down. So if you look at the actual liquidity, the Fed's now thinking, right, the markets are holding up pretty well. We're only 10% down from all-time highs of last year. Labor market's strong. They still need to normalize policy. And I think that is the key here. Forgetting what China does. If China does a Q1 and pumps in $3 trillion, game over, right? Because they do what they do. But right now, liquidity is still falling. It's the hope of liquidity coming in that people are buying the market for right now, not the actual liquidity. So I think that's really, really important.
Okay, Ram, let's talk back to India in terms of liquidity and expenditure. Is there any impact there from the higher US dollar? I mean, obviously, the more that these interest rates are supported in the US, the more the dollar is supported against other currencies. And obviously, making oil more expensive for those who aren't spending in dollars. India, up to a few months ago, was quite sensitive about $80 oil, but now it's like 80. Fine, no problem. Let's just not get to 100. Is that the case? What's its sensitive price these days, given its economic outlook?
Well, it's not that India is not okay with if it goes above 80 or 90, because if it puts pressure on the government's finances, because we are an administered price mechanism, which comes into play in India. So therefore, if the prices move, the oil companies actually they incur a loss. So, but still, then right now, looking at the way the budget has happened in India, I think any price between 75 to 85 seems okay right now. Now, another point is the Indian currency has been pretty stable of late. And in fact, the last 2 to 3 days, in fact, with net positive foreign funds inflow, it's appreciated a bit. So the currency has been pretty stable. So therefore, in rupee terms, I think the oil impact, the price impact of the oil companies has not been very, very high. And third thing is, from an inflation perspective, that's also, it started coming down also. So the government today, as of today, is pretty okay if the oil price ranges between 75 to 85. Of course, the expectations, all the oil price should go down further. And now coming to Maliha's point, whether the oil price will go down any further, if I can add my 2 bits to it, obviously, my view was Saudis will start supporting oil price at around 65 to 70. The reason being they have the social budgets to do it. That's point number one. And we can see I think some more stimulus coming in from China. So therefore, if China pumps in more liquidity or there's more demand stimulus from China, that's the only way the price can actually go up. And then thirdly, I think chances of recession, like what we saw probably in 2008, is slightly on the lesser side. So therefore, to answer your question, I think the prices that's been factored into Indian business anywhere between 70 to 85. Anywhere if it touches close to 100, there'll be a bit of concern in India. So that's the status in India right now.
Okay.
And of course, one more point to add is the pump price in India are administered. It's not that if the oil price moves up by $5, moves down by $5, it's changed on a daily basis. It's administered right now. The price have been very much stable for the last 1 year. And going into the election year this year, I think it will remain stable.
Yeah, and subsidies will come in if necessary at the pump, I'm sure. Thanks,
Yes.
Ram. Let's just look at that a question. More rate hikes and China can assume is neck and neck, 36%, and Saudi oil cuts having less of an impact, which isn't good news for OPEC policy. I mean, I would let you have the last word. Just give us your any updates on other producers that we haven't mentioned today. Iraqi oil, Libyan oil, we haven't talked about that for a while in terms of supply on the periphery, but any updates there?
Yeah, sure. We haven't really seen kind of a surge. All the other members that have quotas more or less been aligned with their commitments. There are still capacity expansion plans across the board in Iraq, the Gulf states. They're still pushing ahead with their expansion of capacity. And one of the main reasons, Diala, that they always argue that volatility is bad for the market, because OPEC members want the world to continue investing in upstream. They want oil to remain a valuable and relevant commodity for the foreseeable future. And volatility in prices kills that. So that's why they're so adamant in saying that we're fighting short-term, medium-term, and long-term volatility, rather than just aiming at a certain price.
And of course, you have, that's the NOCs, but we also have the private companies who are, you know, again, resisting maybe spending, depending what their priorities are. But again, a change of tune there on where they're spending their windfall gains, whether it's E&P or into the energy transition. So that whole dynamic is also in flow. But great to have you, everybody. I'm afraid we run out of time. So this is our last program for the first half of the year. Next week is Eid here, Eid al-Adha in the Gulf. So we will be off air for a few days, and we'll be resuming right at the beginning of July there with our usual start of the month ahead outlook with Mike Muller and Christoph Ruhl from Vitol and Columbia University. So we really look forward to their outlook as we start the second half of this year. Happy Eid al-Adha to those who are celebrating, and have a good week ahead. And we look forward to seeing you all in July. Thank you so much.
Thank you.
Thank you.
Thanks very much.
Bye-bye.
Thank you.